Hello, Night Rider investors. And we actually may publish this one on the Extent Investment channel just because it is important with everything going on out there. I think it's great information for everybody. But of course, my Night Rider investors will get it first. So we've let the dust settle here and are able to take a full spectrum look at the banking system, what's going on with the banks and the bank trouble. So we'll talk about that today. We're going to talk about the Federal Reserve. They just did that quarter rate bump where a lot of folks were hoping that maybe they would pause. And now there's pause and pivot predictions out there. So we'll address that, as well as the real estate market. We're specifically going to deep dive commercial real estate. Residential real estate is so local, we'll touch on it. But I really do want to talk about the broader commercial real estate markets and what's going on there. And for my Night Rider investors, when you guys get this, there'll be links to all the different clips that I've referenced in this video. Of course, as you guys know, we've got economists in there like Daniel DiMartino Booth. We've got real estate experts like Ken McElroy and things like that. So you guys will see those in there. All right, so without further ado, let's jump in. Let's just talk about the hottest topic, which is the banks and the banking troubles that were out there. You've seen so many headlines on like Silicon Valley Bank and what's going on there. And I specifically want to talk about that one, not to continue to beat the dead horse, but just to really open up the hood, if you will, and have you guys take a look under and see what happened there and why these banks are running into so much trouble. So of course you've heard the term bank run, right? There's the great Christmas movie, It's a Wonderful Life, and you've seen that bank run. And that was really the whole purpose behind the FDIC, is to try to prevent a lot of these bank runs. But as you've probably read, the depositors had so much more money than the 250,000 that is insured by the Federal Reserve. So when this bank run came, they were not able to meet all the demands. Why? The reason that is because whether you know this or not, when you make a deposit into a bank, that's no longer your money. It's the bank's money, and you have, it's kind of an IOU that they owe you. Well, the bank doesn't just sit there on the money you deposit. They just don't pile it all into a safe so it's ready for when you come pick it up. In fact, there's something called the fractional reserve banking system. And in my past videos, I've gone into that, so we're not going to talk about it today. But as you guys know, that allows them to lend a lot more than they have on deposit. Well, what they actually do with those deposits is they invest them. That's normally what they do. And they try to invest them in very, very low risk type investments. So what happened with Silicon Valley Bank, what's going on there, is they actually made some bad investment decisions. They took a huge amount of those deposits and invested them in long-term treasuries, a lot of 10-year treasuries, which is actually what the mortgage market is typically correlated with. So the problem is they took and made billions of dollars worth of investments in these long-term treasuries, right, at these very low interest rates, the interest rates at the time, what the treasuries were paying. So let's just say they were 2%. And the numbers I saw, a lot of them are actually lower than that. But if they bought these treasuries that are 10-year treasuries, meaning they don't mature for 10 years, and they pay a 2% yield, that was the return they were getting on them is 2%. Well, because they don't mature for 10 years, they're not a liquid asset. I mean, you can sell them on a secondary market, which is the whole problem here. When interest rates were raised by the Federal Reserve, those treasuries went up. So the rate on them, or the yield, the return, went up. So when that went up, the face value of the treasuries that were paying a lower return went down. So when the bank runs happen and people go, hey, I want all my money back, which is, arguably due significantly to a tweet from Peter Thiel, that's a whole nother story. But when they went to get their money back and the bank doesn't have it, if they sell those treasuries in a higher interest rate environment, the face value is lower. So in essence, it locks in a loss for them. So they start selling all those treasuries to make up for the demand, and it's actually a huge loss to them. And so what you saw the federal government come in and do and backstop and basically say, hey, all these US treasuries that today, if you sell them, would be at a loss, and you'd lock in those losses lower than face value. We'll actually buy them from you, or we'll collateralize you, actually more accurately, at the face value. Because if they were able to just write it out, they had enough reserves and they wrote it out to maturity, they wouldn't have any losses, right? But because they needed to sell them prematurely in a much higher interest rate environment, that's a major loss for them. So that's when you saw the government come in and basically protect them on safe value. And they also backstopped all the deposits. So you've seen the stock market act pretty positively to all of that, which I think is concerning. And you'll see from the clips below, from Daniel DiMartino Booth, for example, and Ray Dalio, and Ken McElroy, that the trouble, the storm is much more likely to be on the front of it, into the front end of it, than the back end of it. So check out those videos for more details. But they're not the only bank that did that and is suffering from the high interest rate environment. There are a lot of banks that are suffering from that. And so that is not everything. I mean, there's Silvergate and Signature Bank and the whole crypto argument going on there. We're not going to really get into that today. But I did want to explain why that bank run is putting so much pressure on these banks. A lot of them are not making good investments with that money. We saw this back in 2008. And if you've watched the movie Big Short, right, what they're doing with their money often is short-term thought. They're not really thinking these things through. And so that's what we're seeing on the banking issues. Yes, deposits are being saved, but what about credit lines? What about future credit lines? So, you know, I'm in the camp that the Federal Reserve is completely locked in on battling inflation for so many reasons. And again, I won't beat the dead horse. We've talked about this in the past. So I just really want to make some concise thoughts for the rest of 2023 here. So some folks in the market, or a lot of institutions in the market, are betting on pauses and pivots this year and all of those types of things. The problem with that is the Fed has two mandates, and one of them is to control inflation and pricing because of what that does to the economy. So a pause is arguable that wouldn't reinsert inflation, but certainly any type of pivot to lower interest rates, any type of stimulus that some are expecting would just exacerbate that inflation problem. So if you've listened to the Fed minutes and Jerome Powell, and Night Riders, I've got a link to Jerome Powell's 8-minute kind of window of what he's talking about. Listen to that. Listen to what he's saying there. Right? They are very much committed to battling inflation, and it makes sense on why they would be doing that. So I don't expect any type of rate reductions or anything like that this year. And I would say it's just as likely that they'll continue to raise those rates because of what can happen to inflation. So you as an investor need to think about, what does that mean for your business if the Fed continues to raise rates, or even if they pause? You need to understand things like interest rates and the job numbers are major lag indicators. And that means that it takes 6 to 18 months sometimes before the results of those interest rate hikes or jobs numbers, the layoffs, enter the real economy. So we're just on the front end of all of that. That's just coming in here. So there's pretty much not an expert out there that I personally follow that is really predicting a hard landing. Now you got some crypto, so we'll say Bitcoin maximalists or huge supporters, and that recently had a rally, although it's starting to tail down again, that are saying, hey, that pivot's coming, and Bitcoin's been pumping, and there's been a lot of money going into that. And I get the argument there. It's because people are losing confidence in the banking system, and that's absolutely true. That's why I'm bullish on Bitcoin in the long run. I think that's the case. But what's going to happen with interest rates in the economy is just not going to support a major bull run in Bitcoin, is my personal opinion. Those risk on assets you need to be very careful of. I think that those are going to struggle. They normally have a lot of leverage that's involved with that. So that's what I think is going to happen. Just to sneak peek forward into 2024, now I'm really going to go out on my personal predictions, is, you know, we have an election coming up in 2024, and the current political parties in power will be doing everything they can to win the votes. And if the economy is in a full tailspin, markets have been crashing, we're in a huge recession, we are in a recession, and that's going on, it's going to be very difficult for them to win votes, very difficult for them to try to keep power there. So what I think, and I'm not the only one that thinks this, but, and it's happened in the past, just take a look at the track record, is at some point in 2024, let's just call it Q2, they're going to get a lot of pressure from the White House. I mean, the Federal Reserve is going to get a lot of pressure from the White House to pivot or make some emergency type conditions. So I do believe the Fed is committed. Right now, I am buying what Jerome Powell is selling, even though the stock market doesn't seem to be doing that. I think that's his key and that's his focus. But when the legislators get together, when the White House gets together, the House, the Senate, and of course the presidential group there, they are going to put a lot of pressure, if not pass law through the Treasury, etc., to help create some relief, some level of stimulus, something going on out there. It's also my prediction that that's how they introduce the central bank digital currencies. If you guys haven't been following that, go back to some of my old videos, Unite Riders, and you can see me talk about central bank digital currencies. There's a lot of downside to that we won't go into right now, but how do you get people to adopt that? How do you get people to become digital slaves where every cent is monitored and how you spend your money is controlled? How do you get people to sign on for that? Well, COVID's a perfect example with stimulus and PPP and those things, is you give money away. You give the stimulus away in the form of central bank digital currency. So people sign on for that to get the free money in an economic collapse and the loss of trust in the banking system seems to be the perfect design. I mean, the perfect storm to introduce a central bank digital currency and, quite honestly, probably walk out an agenda that's been in place for quite some time. So although I don't see any major Fed pivots or anything like that going on in 2023 because of the commitment of the Fed, I personally think that the political powers that be will be able to swing a sledgehammer at some point prior to the 2024 elections. And my guess is Q2, to tell the people, hey, we care, we're doing something about it. We're not just standing on the sidelines. We've taken action here, so vote for us. I really think that's going to happen, and it'll be interesting to see how that plays out. So does that mean that by summer 2024, all is good and everything's going up? No. Remember the word lag I just used, right? Those high interest rates and those job losses, some of those things going on in the economy will lag completely through 2024. They just need to say they did something. And I think it will leak into 2025 for sure. It just takes time to do that. Plus, when they make rate cuts, they don't, drop 2 points or something like that. They'll probably ratchet them down just like they ratcheted them up. So maybe they start with a 50 basis point cut or 75 basis point cut, and then another 50 point or 25 point or, so on and so forth, right? That's normally how they do it. I always like to compare the Fed to somebody driving on icy roads. They're almost always overcorrecting, right? And it takes a minute for that vehicle to correct. And the bigger the vehicle, the bigger the correction there. So those are things to keep in mind. lastly here, what does all that mean for the real estate market and what's going on in the commercial real estate market? Well, if you've seen some of the headlines lately, due to the fact of commercial real estate having these shorter term balloons, you see residential has 30-year amortization periods, 30-year maturity periods, right? So much easier to ride those assets out. But commercial is not that way. They have 5-year and on the long side, 7 and 10-year. So everything that's been going on the last 7 years or so, they're going to have to refinance or sell. And now you're having to look at refinancing or selling in this type of environment with really high interest rates, with a depressed market. And those office buildings never came back to you. So you're seeing strategic default like you did in 2008. What strategic default? It's when we saw it in the housing in 2008, but what's happening in the commercial world on the institutional level is you have these really large institutions, investment companies, etc., deciding to default on their debt because from a business sense, it doesn't make sense to pay their lease debt, what they owe on their leases, for example, or the debt that's coming in that needs to be refinanced. So they're strategically defaulting. And in the world of institution, that gives them leverage against the lender or the landlord to renegotiate those. Because the lenders are saying, no, pay up. We need to deal with today's environment. And the landlords are saying, hey, you need to fulfill your financial lease obligation. Right? They're not wanting to negotiate with them. But once default comes into play, those are huge numbers for the lenders and the landlords, and it forces them to negotiate. And that's why you see the strategic default. So you've had a major correction in the commercial real estate market, even in apartment buildings in most of the nation. The cap rates have gone up dramatically. And what that means is prices have come down dramatically. So that's something to really keep an eye on. That's not changing. And with the interest rate environment and the lag of it, that will continue to be the case. Think about this too. Even though the Fed may pause, let's just pretend they do pause, okay? Because it's possible, right? Definitely. They're still doing quantitative tightening. If you check out that Powell video that I put in the link, he still intends to do quantitative tightening. That means reducing the money supply. So whether you want to increase rates or reduce the money supply, it still heavily affects the liquidity and the money out there in the market. And that, of course, reduces the demand. And that's the whole goal and design of what they're doing. Just go look at all the Fed minutes. That's exactly what they're trying to do. So the real estate market is suffering. And that's trickled down to the residential real estate market. What do buyers buy on? Payment. That's what they buy on. And so with these much higher interest rates, they can't get near the house that they want. And we're still battling some supply issues in parts of the country. I think that's why you haven't seen a bigger drop in price, is because some folks are willing to either pay more or take less of a house just to get a home, right? And so because they have new builds are really slowing down with the cost of construction and the interest rates, that will continue to be a problem. And I think it increases rental demand. That's right. So demand for rental units will continue to increase because it's so difficult to buy a home. And there's no rocket science here. Whatever markets went up the most, if you Google it, those are the markets coming down the most. And it starts with the major metros like San Francisco, LA, Portland, Seattle, those types of things, New York. And then the secondary, tertiary markets do follow after that. I live in one in Spokane, Washington here. Across the border, we've seen Northern Idaho and Coeur d'Alene, Sandpoint, where I also have a lake property out there. We've seen not the waterfront necessarily come down, but the general area, which was one of the top 5 in the nation last year when I was doing these videos, has started to come down significantly. And that's across the board and across the nation. And that just makes sense based on the things that we've covered. So, all right. there you go. There's the Clip Notes version, the nutshell version of things. I think overall, you should expect some stormy weather moving forward. I'll continue to bring you guys updates as we've got significant development out in the markets and the economy, and of course, tie that in to real estate and what we're doing. I'm excited about it all because I'm a buyer of assets. I'm a buyer of real estate, and my investors know we've been preparing for this for the last year and a half. Even maybe 2 years or so. So we're in great position to take advantage of some of those folks that are either over leveraged or, like the banks, didn't just plan very well on what they were doing. You got a lot of those bridge loans where people have done short-term thought in these investments, even though they have longer term plans, or they had exit strategies where they expected interest rates to remain low. And that's just not the case. So you get professional investors like myself, who've been in the business for a long time, are able to see these things coming and step in and take advantage of them. So my Night Rider investors expect to see some great opportunities over the next 24 months or so as we navigate these storms. And if you're not part of my Night Rider investor group, there is a process to be involved in that, but you can contact me directly at tylerv@extantinvestment.com, or of course, search Tyler Benson on LinkedIn and be able to contact me there, because I think we're going to be taking down a lot of awesome cash flow assets in 23 and 24. So if you'd like to be involved with that, my Night Rider investors always get first look at everything I'm doing. In fact, I put a lot more content out to this group than I do public facing. So until next time, to freedom through cash flow.